Hello, everyone. Today's session on International Financial Management subject, Unit 9, Management of Foreign Exchange Exposure. In earlier sessions, we have covered foreign exchange rates, exposures, types of exposures, and calculation of foreign exchange exposures, determinants, factors influencing the foreign exchange rates, domestic markets, role of international markets, and the various types of foreign exchanges, rates, dates, and its impact. Now let's move on to learn and explore the topic of hedging in this unit. Unit 9 is all about management of foreign exchange exposure. In the previous session, we have learned about the various foreign exposure types, calculations, etc. Now let's see how do we manage this foreign exchange exposure. Basically, you will be learning about the various techniques of hedging, contractual hedging techniques, natural hedging techniques. These are the types of hedging strategies which are adopted in order to manage the which we learned yesterday's in the previous session. Then we have techniques that can be used to manage translation exposure. So before we move on, let's see why there is any need to hedge. Hedging. Now this concept of hedging is of two opinions, two schools of thoughts. Under foreign exchange exposure, there are two differences of opinions by two different schools. Now to start with, what isn't hedging in finance? See, it is an investment that an investor makes. Hedging reduces the price risk of an existing position. When hedged, a hedge in a trade means that the very purpose of it is to reduce the risk of adverse price movements in another assets. It takes an offsetting a position in an asset and tries to reduce the price risk which is associated. Suppose if we go with an example understanding the hedges, suppose there is a wheat farmer and the wheat futures market. Supposing the farmer plants his seeds in the spring and sells his harvest in the fall. These months which are involved in production, the farmer is subject to price risk. That wheat will be lower in the fall than it is now. This basically is used by those investors who are investing in market-linked instruments. In order to hedge, basically, you invest in two different instruments which have adverse correlation. This hedging is a strategy which tries to limit risk in financial assets. It uses the instruments or the various market strategies to offset the risk of any adverse price movements in the market. All right. So here we have understood fundamentally what is hedging. Okay, this is a strategy which is adopted in order to reduce the risk of price which is associated in the market. Yeah. So firstly, the school of thought, exposure in the wake of exchange rate. As per the PPP theory, due to the changes in the price level, there will be major impact on the firm's positions. If suppose an inflation rate in India is higher than that of in USA, there will be price risk and the cost of Indian goods in the USA will remain same. So this is one thought. Secondly, there is an argument that foreign exchange rate causes gains and losses to in the previous sessions of IFM, where we learned how to calculate gains and losses, and so is this. Here, when you tend to average out over a period, and this will have impact, this will not have much impact. This is a second thought. And the thirdly, the belief that shareholders are competitive and they know enough to minimize the currency risk by diversifying their investment portfolio. And there is a popular saying by Warren Buffett, don't put all the eggs in one basket. Okay, so diversification, the thought. Fourthly, in a state where hedging does not happen, they use up all the resources. So they have further argument that when market is in respect of parity conditions, the expected net present value of hedging is 0. Second school of thought on this is, which supports the management of foreign exchange exposure, argues that PPP theory is generally not applicable in short term. It criticizes the shareholders with minimize the risk. They argue that management, being professional, should hedge the risk in a better and more efficient way than the shareholders. Okay. It also believes, the second school of thought, that market is normal in disequilibrium due to institutional and structural imperfections. Therefore, expected net present value of hedging is not 0, but it is positive. Now, if you look at this thoughts, we can understand and get a clarity that the hedging of foreign exchange exposure is important. The basic idea behind is to just create a position in the foreign currency which is opposite to the one which is existing, and then balances to become zero. Thus, even if loss incurred from one position due to change in exchange rate, offset counterbalanced by a profit earned on the opposite position on account of same exchange rate change. Okay, so we have here next topic on hedging of transaction exposure. Under this, we learn and focus on understanding broadly two types of hedging techniques. One, contractual hedges. Second, natural hedges. Under contractual, we have another 4 sub techniques: forward market hedge, hedging through future currencies, hedging through currency options, money market hedge. Under natural hedges, we have leads and lags, cross hedging, currency diversification, risk sharing, pricing of transactions, parallel loans, currency swaps, matching of cash flows. So let us now understand each. Forward market hedge is wherein the exporter sells forward and the importer buys forward the foreign currency in which the trade is billed, invoiced, and the forward rate for the currency will be quoted at a rate either below or above the spot rate. In any of these cases, the hedger knows in advance the amount that will be realized in, or is, the amount which is to be paid in domestic currency. And there is no need to guess about the future exchange rate in this scenario. Hedging through currency futures. This is another technique which is applied, which is used in hedging the transaction exclusively when there are large exposure is involved and expected to mature near the due date of the future contracts. These are the conditions. Number 1, large exposure. Number 2, near to the date of the future contracts. As in this case, if flexibility is more in case of forwards and the hedging of the future is not suitable. More or less, the standard size and the contracts that mature at specified rate. This technique of hedging is not preferred in such cases. Next, we have hedging through currency options. Now, currency option will provide the buyer a right. It is not definitely an obligation, but it provides a right to buy or sell at a specified amount of foreign currency on a specified future date. The disadvantage under the forward contract is that the hedger has to honor the contract in every case, and he cannot take advantage of any favorable changes in the exchange rate movement, as it can do in case of options. In option, one has a one has a way to pay premium, which is not recoverable, and if the option is not exercised, if in this process, if hedging in the currency options market, the importer buys a call option or sells put option, and it tries to perform both the functions at the same time. Option market hedging is preferable when there is a chance of exposure becoming a reality. When the exposure is certain, but the direction the exchange rate will take, either increase or decrease, is uncertain. In that case, hedging through currency options is a better choice. Next, we have money market hedging. Money market hedging is also popularly known as spot market hedged. Basically, under this method, the company which has an exposure in foreign currency, it covers borrowing or investing the concerned currency in the money market. This hedge involves a money market position to cover future payables and receivables. For example, an importer who has to cover future payables will have to first borrow local currency. Then they have to convert the local currency into the currency in which they have to pay. And finally, the investments the investor converted amount for a period matching the payments to be made for the importer. Similarly, exporters, on the other hand, who has to hedge receivables, will first borrow the currency in which the receivables are denominated. Then they will be converting these receivables, borrowed currency, into local domestic currency. And finally, they invest the converted amount into maturity with the receipt of the export proceeds. Okay. Suppose if we have an Indian importer have to make a payment for imports worth rupees 1,000 US dollars after 90 days. Now, suppose let's consider this is covered hedge. Now, the importer creates 90-day investment in foreign currency, in which the importer is invoiced. The invoice here is in dollars. Now, initial investment here is that the principal plus interest after 90 days should be equal to the payment for import. Thus, suppose if the rate of interest is assumed at 12% per annum, the initial sum investment will be 1,000 US dollars plus 12%. 970.87 US dollars. Okay, for 90 days. Now, on the day of imports are paid, the importer will receive 1,000 US dollars from the investment, and there will be no problem even if the exchange rate changes. This is the case of covered hedged. Suppose if it is an uncovered hedging, the importer will borrow rupees 38,834.80, assuming spot rate of rupees 40, US dollars 970.87 into rupees 40. Now this converting in Indian rupee to get 970 US dollars and invest them at 12% interest rate. On the day or when it has to make a payment for his imports, it will get $1,000 and there won't be any problem at all. You can see the only cost that he bears is under uncovered hedge is he has to pay on the borrowed amount. Is it clear? On the borrowed amount. Now, similarly, on the same lines, an example is given here, presented for understanding the hedging in case of accounts receivable. This is hedging in case of payables, covered and uncovered. And next we have receivables, covered and uncovered. Moving on to understand decisions with regard to taking up the money market hedge or the forward market hedge. So which one is the best choice? Suppose if the interest rate parity is prevailing and the transaction cost doesn't exist. In this, money market hedge and the forward market hedge yield the same results. But since the transaction cost is always present, the result tends to differ. Assuming R as a 90-day investment rate, that it will equate two different streams, money market hedge and forward market hedge. Now, this formula, borrowing amount X of 1 plus R is equals to forward process. Using this, we end up getting 16.12%. Here R, the break-even investment rate is more than 12% per annum. The calculated R is 16.12%. Under money market hedge, the money market is not so beneficial. Here, as a forward market hedge, here the importer should go for the forward market hedge. But if the forward rate is 39.80 rupees for US dollar, then the value of R will be 9.94%. And here you can see it is less than the interest rate, which is 12%. Money market hedge will be preferred. Money market hedge will be preferred as compared to forward market hedge because the rate of interest is less in money market. Now, taking the same formula, the 9% money market hedge per annum spot rate is given. For 90-day forward rate, rupees is given. You're asked which two hedge should be preferred by an importer. Now, apply the same formula in case of borrowed amount, break-even investment, R should be calculated. Here you can see the break-even R is 9.44%. All right. Then the forward market hedge should be preferred as it has a greater investment rate than what is estimated by the money market hedged. See, money market hedge is 9%, whereas the forward is 9.44. All right, so here we conclude that 9% is the best choice and 9% is being money market hedged. Since it is greater, we go with money market hedging. Next, let's move on to understand comparison between alternatives of contractual hedging. There are 4 alternatives for an importer and an exporter. Let's not consider hedge, no hedge. We have hedging in forward market, hedging in money market, again hedging in currency options market. Okay, now some details here. Spot rate if is rupees 40 per US dollar. 90-day forward rate is rupees 39.50 per US dollar. Interest rates of borrowing in India being USA is 6% per annum. Interest rate on deposits or investment is 5% per annum. 90-day call option and 90-day put option is given, and the various strike rate and exercise rates are provided. Spot rate at 90th day is rupees 39.80 US dollars. Transactions for both imports and exports are given. Now, here let's discuss, as the importer is importing goods worth 1,000 US dollar and has to make payment after 90 days, and he is expecting changes in the exchange rate. In this case, if there is no hedge, the importer does not go for any hedging, so has to make payment after 90 days the prevailing rate of exchange on the 98th day, which means that he will be paying 39,800. That's quite clear. 1,000 US dollars into rupees 39. The spot rate on the 98th day is given as 39. So this is 39 rupees, and by doing so, he gains rupees 200. Rupees 200. Now, how is this 200? See here, exchange rate changes because at the time of deal, the rate was rupees $40, US dollars. So the difference arising is 40,000 minus 39,800. Here, the importer will gain rupees 200. Okay, there is no hedging. He is gaining rupees 200. Okay, this is no hedging case. Next, let's move on. Hedging with forward contract. In case of forward contract, the rate is 39.50. Okay. The rate is 39.50 and rupees 39.50 per US dollars. If the importer goes with this choice, then 39,500 only he has to pay. Now, with this, we understand that there is a difference of 40,000 minus 39,500 goes to 500. This 500 rupees is again a gain to the importer. Okay, now this is forward contract case. Now, supposing if there is a hedging market, in this case, importer will first invest $987.65, so that he will be able to get $1,000 after 90 days to make the payment. So with this, interest on investment is at 5% per annum, which means 1.25% for 90 days. So this, to invest in dollars, he has to borrow 39,506. That is $987.65 into rupees 40. So now with this, you can see a payback of 40,098.59. The principal amount plus interest at 6%, or say 1.5% of for 90 days, is rupees 40,098 rupees 0.59. So with this, it is clear that the importer goes for money market hedge, because here he will have to pay for 40,098.59 rupees for converting the import of US dollars 1,000. So if he had no hedge, he would pay 39,800 in the first case, which means that the importer is at a loss of 298. So hedging in money market will give him a benefit. Next, we have currency options. In case of currency options, call and put options are exercised, both buying and selling. Okay, buying is a call and selling is a put. Call option strike is given at 39.60 rupees and 98th day spot price is 39.80. The importer here will exercise his options of buying and putting, selling, and the exercise price here is 39.80, which is equal to the 98th day spot price. He will not exercise, but pay a premium at rupees 0.05. Now, if the importer is buying only a call option, $1,000, he will exercise it and earns a profit of rupees 150. Here you can see the calculation 39.80 minus 39.60 minus the premium at 0.05 into $1,000. Simplified rupees 150. Now with this, the function of buying call option and selling simultaneously is able to make a profit of 200. That is rupees 150 on exercising the call option and rupees 50, which is paying as a premium, which is already received on put option. So a comparative analysis, if you see, out of all the four alternatives that we have discussed, no hedging, forward hedging, money market hedging, and currency option, the importer will go for forward market. Now, because he gets a maximum gain in forwards. See, in forward, he is getting 500 rupees as gain. In no other type, he is getting the maximum. Hence, the importer can go for forward market hedging. Suppose the same, if from the perspective of an importer we have discussed. Now let's see from the perspective of an exporter. For an exporter, it becomes receivables, whereas for an importer, it is payable, right? So the Indian exporter, if he has to get $1,000, say 90 days case, if with hedging, as we have already calculated, 200 rupees is the the exchange rate that it doesn't go for any hedging. On 98th day, he is due and he will lose 200 rupees. In case of hedging in forward market here, the receivables will be rupees 39,500, which means again here he incurs a loss of rupees 500. Then hedging in money market, the exporter here goes for money market hedge and he will incur a loss. If he is choosing money market, then he will get a loss of rupees 98.52 paisa. In case of currency options, same calculations. Only thing is the term receivables and payables, gains becomes loss, loss becomes gains. So here in this case, he is losing rupees 250. From buying put and selling the call at 150 rupees. So comparatively, put and call, if is analyzed, then finally it is a loss of rupees 98.50. So therefore here comparative analysis of all the alternatives, that's 4 alternatives, the exporter to choose a money market because it is the least loss that it is showing. As compared to all the other 3 are the highest loss. So the least loss has been selected. So the best choice is to go with the least. So on and so forth, you can solve, analyze, and then make a presentation. If it's receivable, it's exporters. If it is payables, importers. Try to understand the case first, do the calculations, required simplifications, and finally give a decisions. Okay. Next, we have natural hedges. Under natural hedges, we have few terms which we often use. Leads and the timing of receipt or payment of foreign currency, and lag is the reverse of lead, which means that postponing the time. Lead means preponing and lag means postponing of receipts or payments of foreign currency. Remember, leads and lags. Lead means preponing, lags means postponing. Okay. Cross hedging. What is cross hedging? It is a technique which is desired to be adopted during currencies which cannot be hedged. In case of cross hedging, the firm has to firstly identify foreign currencies that needs to be hedged. Volatility, which is highly correlated, desired currency, the hedging of the identified currency in the forward market will be a substitute, will act as an alternative for forward hedging of the desired currency. Okay, then we have currency diversification. Smaller the number of currencies in which a firm transacts, the greater will be magnitude of risk. So the risk which will be much lower in which a firm transacts is negatively correlated to a high degree. Therefore, lower the size of exposure, a firm is advised to diversify its operations in larger number of currencies as a hedging tool. Risk sharing. Risk sharing is a contractual arrangement which is made between buyer and seller to agree the share of exposures. This agreement is basically a fixed and mutual consent. And this follows spot rate, current spot rate. Okay, the risk here is shared equally by both the parties. Next, we have pricing of transactions. Pricing is basically adopted in two methods. One is price variation and the currency of invoice. Price variations here means marking up and marking down of the sale price. The basic rule here is to charge price in foreign currency on the basis of forward rate and not at all on the spot rate. I repeat, now the rule of thumb is here to charge the price of in foreign currency on the basis of forward rate. In case of intra-firm transaction, there is a charge different price from arm's length price. This practice is also adopted in inter-firm transactions. In invoicing of transaction, here the exporter may be willing to invoice the bill in its own currency. Generally, the exporter avoids currencies in which the forward market is limited or convertible. The advantage just appearing on account of tax differentials between two countries encourages more intra-firm transactions. If a country exchange control measures, where the exchange control measure limits taking of position in foreign currency, its imports and exports are invoiced in home currency, that's domestic currency. Now, whatever could be its strengths and weaknesses, they're invoiced at domestic currency. This is called as defensive strategy, where the country tries to adopt a strategy which protects in their interest. In aggressive strategy is wherein the hard currency and the imports are invoiced in weak currency. This is not adopted by intra-firm transactions because the gain occurring to one unit is offset to the loss incurred to the other unit. So this is not adopted. So two strategies, defensive strategy and aggressive strategy. Defensive strategy is wherein the exports and imports which are invoiced are in domestic currency. Whereas in aggressive strategy, exports are invoiced in hard currency and imports in weak currency. Okay. Next, we have parallel loans. Indian parent companies. Parallel loan is popularly known or referred as back-to-back loan or credit swap loan. This again is more or less like an arrangement which is made within the country, but the purpose of it is to serve a cross-border loan. And okay, if an Indian parent company will lend the required amount to the US subsidiary in India, and in return, the US parent company will lend the equal amount in dollars to subsidiary company of Indian parent company. And that's how the expiry of the specified period, the two loans will be repaid by the respective lenders. There's need, needs of both the subsidiaries will be met and transactions take place. Back-to-back loan arrangements are shown. See here. Like this, US parent company, US subsidiary in India. Indian subsidiary in USA and Indian parent company. So indirect financing, direct loans in Indian rupees. So direct loan in US dollars, indirect financing in Indian rupees. This technique is more, exchange rate risk has got, avoids the exchange rate risk. Though it is difficult to find a firm that has to lend similar amount of similar maturity, yet it is known as counterparty and is located and cannot be guaranteed at all at the counterparty, which would repay the loan at a specified period. Okay. Then we have currency swaps. Swapping of currency. Now suppose if a firm borrows euros at a fixed rate of 8%, and it can borrow US dollars at a floating rate of 1 year LIBOR. Firm B can borrow euro at fixed rate of 9.2% and borrow US dollars at 1 year LIBOR. If B needs fixed rate euro, it will approach the swap dealers. Firm A needs floating rate US dollar. The swap deal will be conducted different stages as follows. See here. Stage 1. Firm A borrows at 8% interest rate and firm B borrows US dollar at LIBOR. In the second stage, two firms exchange the borrowed currency with the help of swap dealer. A dealer will be representing and acting as an intermediary dealer, swap dealer. After the exchange, the firm will process US dollar and the B will process the euros. Now, third stage is wherein a firm will, A will LIBOR on US dollar that will reach US dollar market to the first swap dealer, and then firm B will fixed rate of interest that will flow euro market through the swap dealer and through firm A. The interest that firm B will pay will be more than 8%, but less than 9.2%. If we assume take away his commission and gives firm A interest at 8.40%. Next and the last stage is the two principles are again exchanged between two firms. A gets back euro and repays the lender. B gets back US dollars and repays the lender. What is the benefit then? Both the firms will get their choicest currencies. The cost of borrowings get reduced for both the firms here. See, cost of US dollars to firm A is absence of swap. That's equal to LIBOR. Cost under swap deal to A firm is 8% plus LIBOR minus 8.40. So LIBOR is 0.40% minus. Cost of euro to firm B without swap is 9.2%, when the cost of euro to firm B after the swap would be 8.60. Now, it is a good tool for hedging the foreign exchange exposure, as a swap dealer designs a swap deal to both the parties by fixing the interest rate in such a way that it influences the counterparty so that both will be getting the benefits from it. Okay, then we have another matching of cash flows. It is a currency not only in respect of size but also in respect of timing. Both the firms, must have both inflows and outflows in the same currency. Okay, this is matching of cash flows. The firm matches its foreign currency inflows and outflows with that of the currencies. Okay. Then next topic we have hedging of real operating exposure. There are different strategies: long-term transaction exposure, as forward, matching, currency swaps, and parallel loans. Marketing strategies may we have market selection, product planning, pricing, policy, product strategy, product source, input, plant mix. So here, all in all, we can see the production strategy, managing translation exposure. How do you manage the translations? Balance sheet hedging, limitations of the contractual hedges in case of managing the transactions exposure, etc. See here, in the keywords, the various terminologies which have been used in this: currency swaps, balance sheet hedging, money market, currency futures. Equip yourself with all these key words. Your conceptual knowledge will increase, followed by focus on learning. For short, the various hedging, money market, forward markets, leads, lags, parallel loans, currency swaps, techniques, risk sharing, strategies, translations, etc. Then followed by focus on learning for long on hedging of real operating, managing techniques. Then in the same line, as in the case of illustrations, there are few problems which you can solve and give a decisions. Yes, so with this, we are done with today's session on managing the foreign exchange exposure. Thank you and wish you all a happy learning. All the best. Thank you, everyone.